Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In this video, I'm going to share with you guys two companies that are my all-time favorites. These companies are compounders. These are high quality businesses. They've been around for a very long time. One of them is a dividend king, and that means they have increased that dividend for 50 plus years, and they are still growing companies. This is the type of companies that you should be owning at the right prices. And what I'm going to do today is go over the business model, go over the valuations for these companies at the end, but we're also going to look at the the financials of this business. Are they really, what makes them profitable business, what makes them good, and just see where they've been over the last whatever years. We'll look at the predictions moving forward, and then at the end, like I said, I'm going to show you the valuations if these companies are a buy right now or what you should be doing. I own them both in this portfolio, so let's get started. Now, if you haven't joined us at the Patreon account, please do so. It really helps the channel, and where you can get all the buys and sells I regularly make, including the family portfolio. I did a family portfolio update recently. I've actually made a purchase of 2 new stocks, sold one, and so on. So yeah, if you would like to join us there, that would be absolutely amazing. The company we're going to talk about today, the first one is S&P Global. This is a credit basically rating company, and they have different sectors within their business. So they've got the marketing side, intelligence side of things that basically made about $4.7 billion. Ratings is about $4.4 billion. Commodity insights, for example, is $2.2 billion. Indices about 1.7. Mobility, which they're spinning off very soon, is also $1.6 billion. So they have a very well diversified portfolio where basically their renting is coming from. So that $14.6 billion comes from each one of these sectors, which is quite nice to see, because that means they've got a very diversified portfolio of basically businesses that they have. Now, within basically this year, they are up about 2%, which is quite nice. Last 6 months they're down just to 1%, which is not bad at all. And for the 1 month is actually up almost to 6%. For the 1 year, it's up about 16, 17, almost 17%. According to Wall Street, this is actually strong buy, and we will get to that in a second. But I want to show you a couple of things about this business, and we're going to move on to more basically simply save dividend. And as you can see here, the dividend is 1.7% right now, so less than 1%. But they have increased this dividend for a very, very long time. Dividend safety 99%. That's the highest any company will get, and the valuations looks like basically is reasonable value right now. So now going down up to payout ratio for that dividend, we're looking at about 23%. As you can see here, they've increased about almost to 6% in the latest increase. For the last 5 years, they have been increasing that almost 10%, and for the last 5 years and for the last 10 years, about 12%, which is really nice to see. And you can see that dividend growing every single year. They've increased this dividend for 51 years, which means now they are dividend king, and that is 51 years without basically increasing every single year and without reduction, which is really nice to see. The payout ratio for that dividend is basically the payout ratio, the annual payout is $3.84. So that's what you will get for every share of this company that you own, and it looks reasonable right now. If we look at the 5 years, for example, this basically dotted line here is within that blue line, which means basically it seems really right now basically it's a fairly valued. Under that basically line, that means it's undervalued, so it is closer to basically being undervalued at this point in time. Now, a couple of things that we need to look at basically right now is you can see the payout ratio is basically declining, which is something nice to see. The free cash flow payout ratio is also basically maintaining the same thing, so that's not increasing. Now, when it comes to earnings per share, in basically from 2015 to right now, it has increased almost every single year, but in 2022 it was a slight dip, and then it basically moved up from there onwards. The free cash flow per share is also heading the right direction. This was slight dip in 2022, and then after that it's actually also gone up the right way. Now, earnings, the shares outstanding was declining, but then of course 2022 it actually increased, and I think that's when they acquired another business, and then it's now actually again coming down again, which is really nice to see. And look at this revenue growth from $5.3 billion in 2015 to right now $14.5 billion, increasing every single year for the last basically 10 years. shares, which is really nice to see. Return on equity, we're looking at about 11%. Return on invested capital, about 9%. Operating margin of 41%. And free cash flow margin of 38%. This is a very high quality business in my opinion, and when it comes to debt levels, we're looking at about 1.3 so for the next, and absolutely amazing business to own and for the long run. Now, one thing we need to look at is to see, okay, all of this is amazing, but we need to do is check this business and to see if it's actually undervalued at the moment, because we don't want to buy a company when it's actually trading higher multiples. So, okay, so we need to be careful, because buying a business when it's actually overvalued can be really risky, especially this volatile market. So according to Seeking Alpha, they actually saying Wall Street is saying it's actually a strong buy right now. So they've got 17 strong buys, 8 buys and 1 hold. Now, if you look at that, that's about 15% upside from where we are. $585 per share is where they think the price should be. Now, if we check out the Morningstar valuation, it also seems undervalued at the moment. $540 per share is where they think the price should be. Right now it's about $509 per share. That gives about 4 stars, and it's a wide moat company as well. So it seems, according to these two guys have actually agreed on. So now I'm going to check using a fast graph to see where the company has been over the last whatever years, just to see, of course, sometimes, the past, of course, it can help us to see where the company has been and, of course, where it is heading in a way. Now, if we look at it, that orange line, okay, is basically the fair valuation on for this company. And what we want to see is that when this black line is under that means that basically this stock has been undervalued. So about 2008 was probably the right time to buy this company, because since then it's actually been overvalued. And then, of course, the 2020 where is the drop around there, that's when it actually dropped, and that was probably another good time to buy. Since then it's been overvalued according to this. Now, if we shorten this time, okay, and the operating earnings was about 11%. So if we shorten that time, you can see still above that line. Even for the last 5 years, it's been overvalued. It seems to have been overvalued. Now, based on the forecast, again, because that's important, we want to see, based on earnings expectations for this company, is it actually undervalued or is it overvalued? So if we use the estimates, okay, and as you can see here, 2026, they're expecting about 12% growth, about another 12% in 2027. If we go back to Seeking Alpha, you will see that information in a little bit more detail, okay? So we've got about 7% in 2025, to about 12%, another 12% for 2027, and then 10%, 9% after that. When it comes to revenue, we're looking at about 5%, 7%, another 7%. So that's what you see here. Now, that is basically the estimates for this company. So if you were to buy it right now, you would we're looking at normal PE of 15 for this company. You will be losing about 15% every single year. So it seems very expensive when you look at that. If you look at the normal multiples, which is what Mr. Market has, basically like to place this company, okay, then you can see for that the 31, that's basically what the normal PE has been for this company over the last whatever years, okay. You can see you will be making about 11%, okay, every single per annum, annualized rate of return of 11% if we just use that. So in my opinion, right now, I wouldn't actually buy this stock. I will, if you were buying it, I'll just buy, be careful. And if you see a massive drop in the next few months, I'll just buy here and there. I wouldn't say it's completely undervalued. And as you can see here, it looks like this trading 212 is making some change. That's interesting. Okay, as you can see here, that's basically my value, basically how much I've got. Return right now is about 1,400 or 31%. Shares, I've got about 16 shares, and average price right now is, for me, is basically 350 basically pounds or dollars, or $287. So I wouldn't be buying it right now, I'll be honest with you. I'm just going to hold on to this. But if it goes below 400 basically, so let's say it gets to 450ish, okay, then potentially I might be actually loading up again to see where we are basically adding a little bit more, because I don't want to right now add just because it's, it still seems undervalued. It still seems overvalued to me. Okay, so that's the first company I wanted to share with you guys. Don't forget to press that like button and subscribe to the channel if you haven't already. Now, the next one that we're looking at today is MSCI, another company that's very similar to S&P Global. And as you can see here, the revenue breakdown, as you can see, if they've got index side of things, if they've got analytics, sustainability, and others. And as you can see here, $2.3 billion is basically the entire revenue. 1.6 of that comes from the index side of things. 683 million comes from the analytics, sustainability, about 333 million, and then 261 comes from all other businesses. And as you can see, that's the revenue, basically that the current revenue, and of course there comes some expenses and so on. Now, the stock looks like it's a buy when it comes to Wall Street, and right now for the year it's actually up for 1 year about 14%. A year to date is up down about 7%. Okay, for the last 6 months up down about 5%. For the 1 month is actually just up fractionally. Now, if we look at the Wall Street expectations for this company, it's about all basic ratings. You can see 7 strong buys, 5 buys, 6 holds, and 1 strong basically sell. And as you can see, it's about 10% upside from where we are. $614 per share is where they think the price should be. Earnings expectations moving forward for this company, we're looking at about 10%, 11%, almost 12% there, almost 13%, another 10%, 11% there, 6%, 7%, 7 to 8% almost when it comes to December of 2025. 2026 they're expecting about 8%, 8% again in 2020 and 2027. Now, looking at the rest of the financial for this company, dividend yield of 1.3, which is quite nice. 61%, which is basically safe. Valuation, it seems undervalued at the moment. Triple B minus when it comes to the credit rating side of things. And looking at the payout ratio is 42% of that dividend. 12.5 latest increase, 25%, basically let's call it about 20% last 5 years, 42%, but they've only been paying that dividend basically for the last 10 years, so there's not a lot for basically a long time, but 10 years is good enough. $7.20 is what you get for every share of this business that you own. It seems undervalued at the moment. If we click the last 5 years, that dotted line is actually basically below that line, which means basically based on the dividend theory, it's actually undervalued at the moment. Now, with regards to the earnings payout ratio, you can see 42%. It's been over the 42% for the last whatever years. Same goes for free cash flow payout ratio. Same thing. Earnings per share has been growing from $2.30 to right now $17.02. Again, absolutely massive growth over the last basically 10 years, which is really, really nice, and I like that. Free cash flow per share, we can see the similar sort of a thing. And when you look at the shares outstanding, it's declining. This is what you want to see. Okay, shares declining, total sales is basically increasing in the right, heading for the right direction from $1 billion to $3 billion almost right now. Return on equity is actually negative equity. We just need to check the liabilities, like current liabilities against current assets, so potentially that's why return on equity is actually in the negative. Return on invested capital 33%, which is really good. Operating margins of 54%, and free cash flow margin of 47%, and debt levels is actually quite low for this company. Now we're going to go back here because I want to check this situation out. So if we go to balance sheet and we check, let me zoom in here. Right, so total current are basically assets of $1.2 billion. Okay, so that's the total current assets against total current liabilities of 1.4. Okay, so 1.4. So that is actually, that's the reason why we've got the negative when it comes to this part here. Okay, return on equity side of things. So that's probably why. So we got more current liabilities, okay, which is $1.4 billion against 1.2 than current basically assets. That's probably why. Now, the other thing we need to check is the total liabilities for this company against total assets. So we got 4.3 total assets against 4. Let's see what this is, $6 billion. Again, that's another reason. So you have more debt, more liabilities basically than actually current assets. Again, they do have some basic, of course, of free cash flow. Let's go to the free cash flow side of things, and we can look at that and see what we're dealing with regards to free cash flow. So they've got $1.1 billion of free cash flow, which potentially they can use to basically cover things. Now it's 3 stars according to Morningstar valuation. So we got 3 stars here, and $540 per share is where they think the price should be. Right now it's just above that at 560, so not far off from where they think they should be. Company has a wide mode, of course, and if we look at the money as fast graph, as you can see here, the company for basically for the last whatever years has been trading along with that orange line. It's been below the orange line for a bit, then it's above it, and then it came back, and then so and so, but then it's gone up so much. If you bought it, let's just say 2021, you were crazy enough to buy this stock, right now you will be losing about 3% basically per annum, of 10% down, so not far off from where it was. But if you bought it, just say for example when it was around below there and hold it up until now, you would have made about 25% per annum basically. Okay, that's one of the things that we need to be careful about buying basically companies that are trading higher multiples, because they will eventually come back to their fair values. Right, so 10 years more or less the same. Last 5 years it looks as it's been exactly the same. Now if we check the forecast moving forward for this company, for example, one of the things that you'll see is based on the current estimates, which is about that 13% or 13% whatever, it still seems basically expensive. Okay, you'll be losing about 17% of your money according to that. If we use the normal multiples, which is what almost the market likes to trade this company, okay, which is about 45, which is very expensive in my opinion, okay, you'll be making about 23%. So we've got another company that's really a wonderful business, but it is expensive in my opinion, right? I do own it. Okay, it's basically it's been in the portfolio for quite some time now, and as you can see, I'm only up less than basically 2%. Okay, I have to have 10 shares of this company. I would love to see this company below 500, and if that happens, and my average being $516 per share right now, slightly higher than that, if it goes below 500, I will be buying more of this company because I really like this. This is probably one of the companies I would love to hold for a very, very, very long time, inshallah. So that's what I wanted to share with you guys, and please, I hope this is sort of a teaching moments to understand buying these companies when they're trading higher multiples, you could potentially lose a lot of your money. Yes, they are great companies. Okay, these, don't get me wrong, some of these companies have got, for example, this one has been beating the S&P 500. If you look at the last 20 years, the S&P 500 return about what, this much per annum. We're looking at, for these companies, annualized rate basically rate of return, you're looking at about, for the last 20 years, 20% per annum for this company. Okay, for the last 15 years, 22. Okay, last 10 years, 25%. And look at the in comparison to S&P 500. Okay, if we look at S&P Global, similar situation. Okay, if you scroll down here, you will see more or less similar situation. So it's beating the S&P 500, but you do not want to buy them when they trade in higher multiples. Okay, you need to buy them when they're actually undervalued, and then hold them for a very long time. Anyway, I hope you're enjoying this type of content. If you are, I'm a very busy person right now, but alhamdulillah, I'm gonna try to do my best, just to share what I can with the community. And if you're enjoying this type of content, please subscribe to the channel. Tell your friends and families about the channel, and of course, if you can join us in the Patreon account, it makes huge difference to me. Thank you very much. Have a wonderful day. Assalamu Alaikum.